Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 261 of the Independent Advisors Podcast, where Mark McEvely and I, Matt Jessup, bring you everything you need to know from the past week in the world of financial markets and financial planning. We're blessed this week to have Aaron Kramer on the podcast, Wealth Advisor with Jessup Wealth Management. Welcome, Aaron.
Thank you. Happy to be back on the podcast in this nice new space.
We're launching the new podcast room. So for those of you that enjoy the podcast via the medium of YouTube, in our videos, you get to see
some changes, right?
You're going to notice some changes. In those that listen on traditional audio, it'll be normal.
Perfect.
That's okay. But no, I encourage you to check out our new podcast room. Jenna Rittenhouse at the firm did an excellent job. So, as always, before we begin, Aaron, let's review the month-to-date and year-to-date performance of the major market indices that we track. This data is from YCharts, and it is from the market close of yesterday of July 17th. So I'll start, Aaron, the S&P 500 index month-to-date up 2.3%, year-to-date 17.2%. Dow Jones Industrial Average, Aaron, month-to-date 5.3%, year-to-date 9.3%, so making up some ground there.
Yeah, that's encouraging.
Making up some ground.
Maybe a little more market breadth.
Yeah, I like that. We're going to talk about that, too. I love that. Nasdaq Composite, month-to-date 1.5% higher, and year-to-date 19.9%. Ready for this? The iShares Russell 2000 ETF that tracks the small cap index, Aaron, up 9.5% for the month.
Wow.
For the month.
That's a big move.
Year-to-date 10.7%. So small caps enjoying all their year-to-date returns in a couple of weeks.
It's impressive.
The Vanguard, the FTSE All-World ex-United States ETF kind of tracks international stocks, up 3.2% for the month, Aaron, 7.7% year-to-date. And a couple checks on yields on some treasuries. The 3-month T-bill, 5.43. As of this morning, the 2-year treasury, 4.42, and the 10-year treasury rate, 4.16. Again, all data from YCharts.
Perfect.
Okay. So before we transition to tweets, articles, and research from the week, anything top of mind about the markets or headlines? I know we got a lot of stuff on the political environment, a lot of stuff in the markets to start the third quarter. Anything top of mind for you, Aaron, that you want to share with our listeners and viewers?
No, just really that we're getting into earnings season, right? So I think that'll be interesting to see if there's some bigger moves and some names in the market. That's really the only thing that's on the top of my mind, other than obviously the unfortunate political stuff going on.
Yeah.
Right. But no, nothing major. I think headline-wise for the markets right now that was on my mind.
I like how you brought up the earnings. What comes to mind to me on that topic that I'm seeing so far is a little bit of what I would call buy the rumor, sell the news. Mm-hmm. And what that means for our newer listeners is I'm seeing some of these stocks, they've been leading higher into their earnings date. And unless they absolutely blow the earnings out of the park,
they're selling off.
They're selling off post-earnings. So I know for the last couple of weeks, we've previewed to our listeners and viewers, hey, if you see some kind of outsized volatility up or down over the next month, there's a high probability it's because they just reported earnings and the market's reacting to that.
Absolutely.
Is that a good way of saying it?
Absolutely. It's perfect.
Okay. I know we're going to talk about market breadth. I have a couple things that are potential warning signs, I would call, with history and the Fed.
Yep.
I'm going to dig in if you're good with that.
Yeah, let's get into it.
So the first thing I have for our listeners and viewers is a piece of research from BarChart. And this piece, Aaron, is from July 13th. Okay. And this chart will be put up for our YouTube viewers. This will be in our show notes. All of our show notes is accessible on Jessup Wealth Management's social media on all the various top sites. And the piece that I'm going to call this is Potential Federal Reserve Rate Cut Sometime in the Second Half of 2024. And what you're going to note from this chart from BarChart is on average, the S&P 500 index has fallen 23.5% over a period, Aaron, of 195 days from the first Federal Reserve rate cut to the market low. And so what bar chart put is, keep this in mind if the Fed begins to cut rates in September. I wanted to get ahead of this for our listeners and viewers. One thing I'm proud about on the podcast is we tend to be very forward looking.
Sure.
And I feel that what's going to happen when we get to September, and let's assume for a second that they do cut in September, I feel you're going to see clickbait articles related to what I'm about to just discuss.
Absolutely.
Okay. I want to get ahead of it because I think it's going to be a very prevalent narrative in the market. Okay. So here's my thoughts on this. Does this mean the market will sell off after the Fed makes its first rate cut? No. Historically, Federal Reserve interest rates, they cut them to spur economic growth. In my opinion, underlying economic data has been fair to good. So I don't think there is an immediate or imminent danger, but I think investors should be aware of this type of data. When looking at the market through the lens of history, the market doesn't necessarily repeat itself, but it rhymes. And I think investors should be aware of where we are in the overall economic cycle. And history is telling us to have our guard up once the Fed starts cutting interest rates. Should this data point within itself cause a quote-unquote sell signal? No, in my opinion. Investors should be aware of history. There are outliers to the data, such as 1980, when the market did not sell off. Okay? So your thoughts and comments when you see this information, this data, knowing that this narrative is going to be very prevalent in the market coming up here.
Yeah, I mean, you know, it's like anything else. It's a data point, right? So it's not a reason to make massive strategy changes, in my opinion. I think it's more important to stay within your own risk range and risk tolerance for the long term. And not chase the market, you know, based on some data points, right? And I always, you know, like to think that, you know, the economy is not the market's not the economy, right? So
well said.
The market can absolutely
We've heard that a while on the podcast, and I like you reminding our listeners and viewers about that.
It's, you know, the market's always forward looking, right? So I think the reason it has a chance to sell off is that if the Fed starts cutting rates, it's a sign that the economy is weaker and it needs that stimulus. So it would make sense why the market would pull back during a rate cut cycle, but doesn't mean, you know, history doesn't always repeat itself. That's what I'll say.
Well, on this same narrative, just to make sure I get all of this information out there, I just communicated historical data after the first rate cut. The second piece I have is from Global Markets Investor, and this was posted on X on July 7th, Aaron. And this is what it says. Recession in the U.S. usually comes within 18 months from the last Federal Reserve rate hike. We're looking at the opposite side, okay? It's been now 12 months since the last Federal Reserve hike in July of 2023. If history's any guide, the U.S. economy should fall into a recession before the end of the 2024 year or is already in it. In the source of the data on this chart, it says, is the Federal Reserve Board, Haver Analytics, and the Apollo chief economist. So Jenna will put up this chart for our YouTube viewers. This will definitely be in our show notes. So I want to come at it from the other angle of the data from the last time that they hiked rates. Again, does this mean a recession will happen within the next 6 months? No. Does it mean investors should be aware and monitor economic data a little closer? Yes, in my opinion.
Absolutely.
So I want to come at it from both routes because I think you're going to see a tremendous amount of headlines, online especially.
Absolutely.
After this first rate cut, let's assume it happens in the second half of the year. That's not guaranteed.
I have a point that is pricing in the chance of that. So I'm going to jump ahead once we're ready.
Why don't you just go into it?
Okay, perfect.
And we'll come back.
Yeah, no, it fits.
Well,
it fits
fresh.
right in.
I like
it. Fits right in. I didn't look at yours, so it's
That's what's great about the podcast.
It's all these themes in here.
What's great about the podcast.
So just to jump in, it's an X post by Bespoke, and it's markets pricing a 0% chance of no rate cut by September.
0.
So it's saying basically the market is expecting 100% chance of a rate cut by September.
Interesting.
So they worded that kind of backwards in my opinion.
I get it.
But that's what it's saying. So it's basically saying there's, a 90% chance that the Fed funds rate is between 5 and 5.25. And, the other 10% is, 4.75 to 5. So,
wow.
So the market is definitely pricing in a rate cut by September, it looks like. And,
yes.
I think that's interesting with the points that you brought up. But the Fed's going to do what they always do. They're going to say they're going to be data dependent, right? So
yeah, it was interesting. I was at a conference back, I want to say the month was March, Aaron, and they had a high up representative from Apollo at this conference. And he gets up there and he's like, Apollo thinks there'll be no rate cuts this year.
Really?
Now, imagine how polarizing such a statement would have been back in March, right? And it's just interesting that now you have this data come out. Okay, everyone's expecting them to cut rates in September.
But what's the argument that if they don't, how does the market react?
Exactly. Right? And I think I go back to what I've been telling our listeners and viewers for roughly the last 6 months, which is the following, and this is important. Mm-hmm. The longer the Fed keeps rates where they're at, and once they start cutting, the slower the pace of cuts, when you look through the lens of history, the better that tends to be for risk assets.
The less market volatility there is, the better equities perform.
And maybe the market's overlaying the fact that we are in a presidential election year. There's that kind of unspoken pressure for the Fed to be unbiased. And
but there's going to be some political pressure.
There's going to be some political pressure, right?
Right.
Anything else you want to cover?
No,
on that?
I just wanted to mention that Bespoke post or X post was from FedWatch Tool is the data they got that. So, that was on July 16th. So just 2 days ago.
Love this. And again, the next Fed meeting is in about 2 weeks. Mm-hmm. Okay. So the market's expecting that cut in mid-September because the Fed meets every 6 weeks. So we are 2 months right now ahead of these headlines, listeners and viewers, that you're about to see.
So when that CNBC Post headline is doom and gloom.
That's right. You're going to think back to episode 261 of the Independent Advisors podcast. So my next point is about market breadth, which you alluded to at the top of the podcast, Aaron. So this piece is from Charlie Bolello. Charlie posted this on July 15th. He said, quote, U.S. small caps are up 6.8% over the last 3 trading days, while U.S. large caps are flat. The 6.8% spread is a 6 standard deviations above the mean, and the third largest small outperformance since the inception of the first small cap ETF in May of 2000.
Wow.
Okay. Jenna will put up this chart for our YouTube viewers. This will be in our show notes. A couple of very raw and transparent thoughts on this. Okay.
I'm ready.
First of all, just because you have a dramatic outperformance by small caps doesn't necessarily mean that it's going to continue.
Right.
Okay.
Absolutely.
What I will throw out there, and this is no secret for our regular listeners of the podcast, if you look at performance of not only large caps, but the mega cap names, so the top, say, 10 or 15 largest by market cap, since the market bottom in the fourth quarter of 2022, there's been a huge performance disparity, right?
Yeah.
And those mega caps have done so much better than small and mid caps. You will have some reversion to the mean trades. What we don't know and nobody knows is that going to come in these chunks like you've seen so far here in July? Is this going to continue? And there's a lot of factors at play. I just want to make sure our listeners and viewers are well aware that you've had this dramatic outperformance, not only by large, but by mega cap names, and you're starting to have small caps catch up. To put it into perspective, my last piece that's associated with this is a post on the 16th of July from Mike Zaccardi. He's a friend of the podcast, and he showed a chart that is year to date of the SPY. So SPY is an ETF that tracks the Standard & Poor's 500 index, and he compares it to IWM, which is the Russell 2000 small cap ETF, as well as the triple Qs, which is a ETF that tracks the Nasdaq. And what you're going to notice on this chart is the dramatic move in small caps over the last roughly week or two. Okay, this huge catch up. I think it also goes to exemplify that historically looking at it, there tends to be more volatility or risk in small caps compared to large. And just as much as it can benefit you on the upside, it has the ability to really sell off.
Absolutely.
So just want to kind of give our listeners and viewers a level kind of view on that. But again, you are starting to see small caps run here.
And I think it makes sense. I think, my opinion with those mega cap names running up so much the last 18 months.
Yes.
It's probably due for some rotation, right?
Well said.
And where's the next logical place, right?
Yes.
And small caps that haven't performed year to date.
Yeah, I mean, I'll kind of put it very simplistically. You got everyone, and if you put all the heavy decision makers in Wall Street in a room, everyone's looking around and saying, where's the value now?
Right.
Well, it's tough to find value in the mega caps that have run so much.
Highs, right?
Doesn't necessarily spell doom and gloom in the immediate future, but it doesn't surprise me to see this rotation.
Honestly, maybe some healthy rotation, my opinion. I love to see market breadth.
I think that's exactly what Mark McEvely would say if he were in this room right now.
Absolutely.
All right, I'm going to send it back to you, Aaron.
Perfect. I'm going to change topics a little bit here. I've got a tweet by Ben Carlson, great blog writer and researcher, on 7/16, and his X post was titled "Total Returns in the Past 5 Years: U.S. Stocks plus 95%, U.S. Bonds 1%." And the data he's looking at from Y charts is what he's using is the Vanguard Total Stock Market ETF, which is VTI.
Okay.
That's up 95% over those last 5 years. And then the Vanguard Total Bond ETF, which is BND. So just my initial reaction is I didn't even realize it's that drastic of a disparity.
Yeah.
I think it really stems from ultra low interest rates in COVID.
Yeah.
But it almost looks like an opportunity to me at this point in the bond market, right? So especially with some upcoming, potential volatility into the election. Again, this isn't a recommendation for bonds or anything like that, but I just think it's interesting with rates kind of peaking. It could be attractive for investors locking in those longer maturities, for bonds while they've been flat for 5 years. Right?
Well said.
So any thoughts you have on it?
My thoughts, it makes me think of the narrative in the market of a traditional balanced portfolio, which I will put as 60-40, 60% in equities and 40% in fixed income. And that's a very kind of popular mix for moderate to moderate aggressive oriented investors, right? And what's happened is you've had a lot of articles written over the past 3 years talking about, is the 60-40 portfolio dead?
Dead, yep, exactly.
Right? And you've seen these. I know a lot of our listeners and viewers have seen these. My comments on the forward-looking returns on bonds is as follows. The quicker the pace of interest rate cuts, the better historically bond returns will be.
Right, because the pricing, right?
You got it.
As interest rates come down,
that's right,
bond prices should rally.
That's right.
Theoretically.
That's right. And so when you think of that narrative, that 60-40 kind of portfolio finally, statistically speaking,
feels like it might make sense.
It might actually bonds might start actually pulling their weight in that mix. Is that a good way of saying
Absolutely.
it?
Absolutely.
I like that you highlighted this too, because the other narrative I want to dispel is, and I've said this on the podcast, this stuff is all time-stamped. Before bonds sold off, we went through a period of over a decade where bonds on a calendar year basis were never down.
Yeah.
And so you had this feeling in the market, which I do not believe this statement, but the feeling in the market was you can't lose money in bonds.
Yeah. It's almost like a guarantee, right?
That's right. And I was out there, and it's on the podcast, it's time-stamped, like, listen, there's more risk in bonds than people give it credit for.
Absolutely.
And I just throw this out there that historically speaking, just general asset classes, are bonds historically more conservative than stocks? That's a true statement on a relative basis. But it doesn't mean bonds within themselves are just a quote-unquote safe investment.
Right.
That's not necessarily true.
It depends on the credit rating of the
depends
companies,
on a lot
the
of
type of bonds,
the length of maturity.
Sure.
So just want to kind of just educational kind of pieces for our listeners and viewers.
Absolutely.
Love that you highlighted this.
Perfect. I got one more for you.
What do you got?
And it is it's an article or some research and some charts by Jennifer Nash on Advisor Perspectives as of 7/17. And this kind of plays, into the economy's strength or weakness, and it's titled "New Housing Starts Increased 3% in June." So she made the note that in the latest report by the Census Bureau, housing starts increased to a seasonally adjusted annual rate of 1.353 million in June, surpassing the forecast rate of 1.3090 million. This marks a 3% increase from May and a 4.4% decline compared to 1 year ago. So for me, this is somewhat encouraging for the overall economy, because new housing starts are a pretty good indicator of consumer confidence and spending, and
You don't have a lot of builders doing spec homes.
No.
Right?
No. Yeah, absolutely.
So a lot of times when they're building these homes, they got a buyer already lined up.
Absolutely. So, if you look at it's really interesting to overlay this chart. They show it with recessions, its current level, and the 6-month moving average. So, this we've seen somewhat of a downtrend in new housing starts. It looks like since 2022.
Yep.
They've actually ticked up just slightly since 2023, which is encouraging to me. So,
Correct.
Second piece of this chart is housing starts as a percent of the population. So this is really interesting.
Oh, okay.
So it overlays the same chart, the 6-month moving average, and the new housing starts with total population.
Interesting.
And over time, it's obviously a regression. Our population slightly declined, but also I think the level of home ownership has declined in the U.S. But it's really interesting. It recovered significantly from the Great Recession in 08-09, and it's kind of leveled off over the last few years here. So any thoughts you have? I just thought it was an interesting piece of data, and I think it's kind of a double-edged sword. It's somewhat encouraging, but if you look at it from a long-term trend, it's not as encouraging.
I think housing is very interesting right now in general. There's a lot of cross currents in it. I like this. The housing start data is very encouraging. The items I've talked about recently in the podcast for maybe viewers and listeners that aren't as consistent every week, I've made some comments about housing supply. Mm-hmm. So the latest data point I mentioned on the podcast a couple of weeks ago is we're a little bit over 9 months on a national average of housing supply. And if you go back several decades, it averages about 6 months.
Okay.
In addition, I am concerned that with excess supply, I don't care if we're selling widgets or we're selling a service, when you have excess supply of something, what happens historically to pricing?
Prices come down.
Prices tend to come down. That's something that I think needs to be watched very closely over the next year. The other aspect at play, and I talked about it recently, is all of these home equity value gains that the average homeowner has experienced the last 5 years. On average, they've not been able to tap that equity.
Right.
Like
it's
normally.
been dead money, right? Because rates are so high.
And so I question that if we have some economic weakness over the next couple of years and the Fed starts to lower interest rates,
That's where cash
I'm
flow
going to be a
from.
forecaster. The consumer's going to be buoyed by tapping into that equity.
Yeah, that's
You're
a
hearing
great
it
point.
first on the Independent Advisors podcast. I think it's going to lead to that the next couple of years.
That's very interesting. Because in this industry, I have not seen a significant amount of HELOCs at this point.
No.
They're extremely minimal.
Extremely
and right now,
minimal.
it makes sense if the if mortgage rates are 7, HELOC's going to be 10 or 11, right?
Yep.
So it's been
And
unattractive.
a lot of banks aren't even doing them anymore.
Well, they're not selling, and they're not attractive right now.
Yeah,
So
and I think you'll see more just if you get mortgage rates below 5, which could take a long time.
it could take a couple
But
years.
I think if you do get longer term mortgage rates below 5, I think you could see an immense amount of refis, people taking some equity out. And who knows what they do with it? Do they
Right.
pay off debt? Do they do home renovations? Do they buy other stuff, right?
all the above, right?
But the thing I'm getting at is I think that's a piece that could buoy the consumer if we see some economic weakness. And I just don't think that topic is getting enough credit right now. Because I talked about a couple of weeks ago that massive move in equity that homeowners have experienced.
Like a 45% average move, and
In equity, it was huge. I mean, we're talking
3-4 years.
trillions in
insane.
home equity. So definitely a topic that I think is not getting enough headlines. Glad you brought this up.
Absolutely.
Glad you brought this up.
Somewhat encouraging data, though, so we'll see.
Yeah. Well, I think we're bumping up against our time limit. We do have a financial planning topic of the week, but I know we saved it last week. I'm going to save it again.
Perfect.
Just out of consideration for our listeners and viewers. For our newer listeners and viewers, our podcast usually runs about 30 to 40 minutes. I want to be attentive to that.
Absolutely.
Couple items, though, I do want to talk about before we get off is how we host this podcast. We use a podcast hosting site called Blueberry, and that is spelled Blubbrry. If you want to create your own podcast, use promo code JessupWealth to get your first month of Blueberry podcast hosting for free. To choose the ideal plan for you, use the hosting estimator on their website. Again, you can receive your first month for free with promo code JessupWealth. That is all lowercase, no spaces. And also, Aaron, if our listeners and viewers are looking for a good piece of AI software to help them note take and summarize a meeting, we highly recommend using Firefly's AI software. You can use the link in our show notes below to purchase your subscription and make life a little bit easier. As we sign off here from episode 261, closing thoughts, Mr. Kramer.
Only thing I have is that, I think some potential short-term volatility in the market is likely over the next few weeks here. It's just kind of my initial feeling. So investors be prepared for some volatility. Don't pay attention to the news headlines too much. Read through them.
I think you said it well. Yesterday we saw a nice sell-off in larger cap stocks. I believe yesterday would have been July 17th to be very specific. Nasdaq sold off about 2.7%. S&P sold off about 1.4-ish%. And it wouldn't surprise me to see some short-term weakness in the market. That weakness could last a couple of months.
Right.
But I think when you look at things from a bigger picture perspective, you have to anticipate an uptrend that there's going to be corrections.
Absolutely.
And if you are somebody who's listening to this podcast, and let's just say that you have not the equity exposure you're seeking, extra cash that has a long-term investment time horizon, you're going to get some plays at bat over the next 12 months. And the question is that it's going to feel uncomfortable to take a swing, is my analogy.
Yeah, especially with cash and CD rates being elevated, it's difficult to give up that 4-5%.
That's right.
And take a
risk-free rate.
Right. But I think those are going to start going away.
Yeah, just start
towards the
thinking
end of the
longer term. What's the goal of this money? Am I willing to subject it to risk and volatility? What are my true goals for these assets? And when you have these types of kind of sell-offs or corrections in the market, could be an opportunity.
Good buying opportunity, right?
All right, we'll sign off. Thank you for listening to episode 261 of the Independent Advisors podcast. Myself, Aaron, Mark, Nick, Jenna, and Taylor, who regularly handle the podcast, appreciate you guys listening. And we'll be back next week with episode 262. Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.